What I want to do is go through these one by one. We'll begin with what I call the first principle of a proper financial plan. It's entitled, Doing Things in Their Proper Time and Order as Time and Money Allow. Now you would think that that's a very straightforward thing and that most people get it, but you'd be surprised at how many people violate the first principle. Have you ever met a young couple who shortly after getting married went out and got a nicer car than mom and dad had and got into a house and went and bought a bunch of furniture and so on and so forth, where they felt like they had to get everything that mom and dad took a lifetime to accumulate, that they had to get it right away? And then they have a financial hiccup. Maybe they lost a job, or it didn't pay as well as they hoped, or something along those lines. And then they ended up losing almost everything. You see, they did things out of their proper time and order. They didn't do them as time and money allowed, and they violated that principle. What you'll find with a principle is that a principle is not on trial. It's not open for discussion. It's not out there for us to redefine. They are what they are. And if we abide by them, then we'll see the benefits. And if we violate them, then generally there's going to be a negative consequence. So with this first principle, I always use a picture of a pyramid. So with principle number one, we'll start with this pyramid. This pyramid, the reason I use it is because they've been around for thousands of years over in Egypt. And I always ask my clients, why do you think they're still standing? What is it about them that made it that they could withstand everything that Mother Nature could throw at them? You know, wind and rain and sun and sand blowing against it. I don't think they ever get any snow, but you get my message. Why are they still there? It's not a trick question. The answer is very simply this. It's because of the foundation. They started with a really broad, solid foundation, and then they worked their way up. It's the opposite, if you will, of the Leaning Tower of Pisa over in Italy. Why is it leaning? Because the foundation wasn't in place. You and I both know that if you go look at the home show and you walk into a house, you look at all the accoutrements and how well it's decorated, and the marble kitchen countertops and so on and so forth. Have you ever seen anybody walk up and kneel down and look at the foundation and say, man, that's a fantastic slab of concrete you got there? They don't do it. But let me tell you this, if that foundation slips, how valuable is the house? It just lost all of its value. We have houses around here that are built on the mountainsides. As soon as that mountain starts to slip and that house starts to see the foundation crack, guess what? All of their equity, everything they have about that house is gone for the most part, because insurance doesn't cover it or anything else. Well, the analogy is this. When you get into financial planning, if we build your financial plan properly, it will withstand the storms of life. Well, for example, what are some of those storms? Well, there's premature death. There is a financial setback. There's disability. Any of those things can affect us in ways that we never imagined. And if we've done things out of their proper time and order, we'll find that we're in a really, really rough place. So with financial planning, we want to make sure that the foundation is always going to be protection. We have to protect against the things that can go wrong so that we can earn the right to invest in the things that can go right for us. The second layer of this is going to be savings and or debt reduction. What I found over 19 plus years now is that these are like two ends of magnets, opposing magnets. They don't play well together. Either somebody has a lot in savings and very little in debt, or they have a lot of debt and very little in savings. I've never seen somebody that had both, very rarely. So they just don't play well together, and we understand that in order for all this other stuff to work, we have to have money in savings, and we have to be working on reducing the debt. Now, understand, I'm not talking about debt to buy a house necessarily, or debt to go to school. I'm talking about consumer debt and things that can swallow us and eat us up that way. The third thing is going to be real estate. And when I talk about real estate, I'm not referencing investment real estate per se. I'm talking about a primary residence. Now, I'm not a real estate agent. I'm not going to pop you in the car and drive around the neighborhoods and help you pick a new place to live and tell you to sell what you've got. But here's what I understand from a financial planning standpoint. Oftentimes, a home can be your number one asset. Why? Well, there's two great things that you get from owning a home. Number one, over time, you're going to get equity. Most of the people that I sit down with, one of their biggest assets, if not their biggest, is going to be the equity that they have in their home. The second great thing that they get from a financial planning perspective is they get a tax write-off. Interest in your home, on your home mortgage, is your friend. It's one of the few things that we have left that we can deduct. So we have to make sure that we don't necessarily kill that too quickly, that we understand the proper ways to get out of debt. The last one, the top one, is going to be retirement planning. Now, I'm not a banker. I'm not going to come to you and say, hey, we've got some CDs that you need to look at or some money markets, but I understand the value of saving and getting out of debt, and we'll help you understand that as well. I'm also not a real estate agent, as I said, but the two places that we really excel, the places that we really help people, are going to be on the protection piece and on the retirement piece, and show people how those two things can intertwine and benefit you greatly. So we just want to make sure that we do things in their proper time and order and as time and money allow. Asset allocation really stems from something called the modern portfolio theory. The modern portfolio theory was developed in the early 1950s by a gentleman by the name of Harry Markowitz, along with his partner Thomas Sharp. They were both with the University of Chicago, and they were in the economics department. And they were looking at the stock market, and they were trying to understand what was causing growth in the stock market. Why were people's retirement portfolios, why were the big pension plans of the large companies growing so well? And they threw out a hypothesis, and the hypothesis was this. They thought it was due to three things. The first thing they said was stock selection. Stock selection is based upon research and analysis, on people looking at the different companies, the different stocks, and being able to advise people, in their opinion, based upon their research and analysis, of how well that company is going to do or not do, and give people instructions on when they should buy or sell based on that. The second one was market timing. Harry thought, you know what? There's a lot of people out there that try to time the market. They're looking at economic factors, at political factors, and they're saying that we think now would be a good time to make a move, whether to buy or sell XYZ company and so forth. The third thing that they threw out was asset allocation. And you'll notice that asset allocation is the second principle. So it stems from the modern portfolio theory. So what Harry said and Thomas said was each of these in our hypothesis is going to be worth 1/3 of the return in the marketplace. And then they set about studying it. Now, in 1990, Harry Markowitz won the Nobel Prize in economics for the modern portfolio theory. It'll be interesting, I'll share with you here in a second what actually came from that and why he won the Nobel Prize. But he had to define asset allocation for people so that they understood it, because most people understood market timing. I've used the example of people illegally timing the market because they have insider information where they found out ahead of time that the pharmaceutical company that they had stock in was not going to get approval from the FDA. And as soon as they found that out, they sold their stock at a high price, whereas the public had to wait until some future point when the news hit the airwaves, and they ended up taking a loss somewhere along the way. That's illegal. It's not allowed, but that's a form of market timing, getting that insider information. I've seen it in real estate. People say, you know what, the market is growing so well and my home is appreciating so fast, I can take equity out of my house and I can go buy the house down the street, and I should be able to sell that house in 90 days and I can flip it. And when I flip it, I'm going to make a boatload of money, and I can help pay back the money I borrowed out of my house, and I'll have extra left over. The problem is that they didn't know that the market had already been declining. They ended up losing the house down the street because they couldn't make the house payment on it, and they ended up losing their own home because now they had two payments. They had the first and the second mortgage. That's another example of people trying to time the market and not working out too well. And then the stock selection, as I said. So here's asset allocation. Asset allocation says there's three big, broad asset classes where we can invest. The first is going to be in a cash position, which is going to be checking, CDs, etc. The second is going to be fixed income. And for our purposes today, fixed income is primarily going to relate to bonds and then equities. And equities is going to relate to mutual funds, stocks, could even be your small business or real estate. Anything where you have ownership is going to explain or be a category of equities. What you're looking for is risk and return. If risk and return are yours, if you take that challenge to go out and start your own business and it does really well, you hope to earn this great return. But if it doesn't do so well, you bear the risk. That means that ownership is affecting you, and therefore what we're talking about is an equity. If it's a loaned position, it's going to be a bond, and if it's cash, we all understand cash. Well, what ended up happening is Harry went out and did this study. When they came back after more than 40 years of studies, they found that these two, instead of being worth 1/3 each or 67% of the overall returns, they were worth less than 6% combined. The other 94% of returns was due to asset allocation. So I always tell people this, as an advisor, if I'm going to help people manage their money, I cannot manage based upon chaos. I can't manage upon guesswork and wondering if I'm going to get it right. I have to manage upon things that I know are true. And the principle is this: asset allocation is responsible for 94% of the returns. Therefore, that's the place I'm going to play. Now, the third principle is called diversification. We've all heard the adage that we don't want to put all our eggs in one basket. That's what we're talking about, only on a deeper level. So with asset allocation, we talked about the three broad asset classes of cash, fixed income, and equities. And if you sat down with us as advisors and you had $100 or you had $1 million, it wouldn't matter. What we're going to do, once we understand what your risk tolerance is, what your time horizon is, and what your objective is, then we can say, hey, of every $100 that you have to invest, we're going to take, for example, $30 and we're going to put it into these two categories. So there goes $30 of our 100, and the other 70 is going to go into equities based upon these things, assuming that this is conservative, this is aggressive, and this is moderate. Let's say that you fit right there. Well, we're going to put you in a 70-30 portfolio, for example. Then we're going to do this. Now, what diversification says is, okay, now where does that $70 go? How am I going to break that up or split that up? Same thing with the bonds and the cash. So let's talk about diversification as it relates to equities. Just real quickly here. When we sit down, most people will relate to this. If you've got a 401k, you've probably seen opportunities to invest in places like large cap value or small company growth or international stocks, so on and so forth. Most of us don't really understand what that necessarily means, but we're probably subliminally affected by the words large and growth. So we're like, oh, well, if it's big and it's growing, then maybe that's someplace I should be, which I would not argue against, except that I think that we tend to put too much money in those locations. So let's go through this a little bit. When it comes to diversification, we've got large companies, we've got mid-sized companies, we've got small companies. I could even add international here to give you another category. And then across the top, we have value companies, we have blend companies, and we have growth companies. What we would do is just to help clients kind of visualize this, we'd break this into a quick chart to show you each sector. What we're simply saying is, look, of that $70 of every 100, we don't want it just all in large cap growth. Some needs to be there for sure, but where does the rest go? All we're suggesting is let's not put it all in one place. Let's split it up and have some in various locations so that we have some diversity. Now, depending upon your risk, the more we might have in large company growth or so on and so forth. But what we'll find is over the long haul, we're going to help maximize this, or optimize it may be a better word. The fourth principle that I want to get into is called rebalancing. When you look at rebalancing, what we're really saying is, once again, let's start with your portfolio. Let's say that we had you in a 70-30 portfolio with 70% going into equities and 30% going into bonds and cash. Well, now let's say that a year later or 2 years later or 3 years later, for whatever reason, we were now at 50-50. This is a really important phrase, and I want to make sure it sticks in your mind. What's happened in your portfolio is less important than what we do about it. Now, why do I say that? Because time is our friend. If we have time to invest, if we have a significant time horizon, then the ups and downs are just a part of what our portfolio does. We have to embrace that. It's actually why we get paid a premium on our returns, is because we're taking that risk. And we understand that it's going to go down, but we also understand that it will come back up over time. A lot of people mistake volatility for risk, and they look at it and they say, man, volatility is just a synonym for my money can go down in a hurry. When in reality, volatility also means my money can grow really fast. Great things can happen in a short period of time. We've done studies and we found that over a period of time, when people get scared because the market's dropping and they move all their money out to safe, conservative locations, and then they think what I'm going to do is wait till it comes back and I'm going to jump back in. We've actually found that people will, if they miss the 5 best days over the last 30 years, their return will be decreased by over 10% by just missing 5 of those days. Now, if you do the math, that's a whole lot of days. And just missing 5 of them is huge. So the example that I've seen is that if somebody invested $100,000 in 1970, and we'll go with 40 years, in the year 2010, that portfolio just being invested in the S&P 500 would be worth almost $5 million, at $4.9 million. If they missed the 5 best days because they got scared and moved to safe conservative ground and didn't catch the upswing, that return now, their portfolio, instead of being worth $4.9 million, would be worth about $4.5. So it's not quite 10%, but it's close. If they miss the 15 best days, it's a 35% decrease, and on and on and on. What I'm trying to tell you is that market timing doesn't work. The reason rebalancing is so important is because it helps us make these changes in our portfolio without it being attached to emotion. Emotion is your enemy when it comes to investing your money. Too many people get wrapped up in their little, package and they're like, uh-oh, it's lost money. I can't handle it. Man, I got to sell. I got to get out. I can't do it. And then they say, I'm going to sit over here. And then it starts to go back up and they say, I'm going to wait. I got burned once. I'm not going to get back in yet. And they wait until the price goes up and up and up, and then they get in. It's a little like saying, hey, the price of gas is $4 and you bought a big tank full of gas at $4. The price starts to drop down to $2 and you're saying, hey, I got a bunch of gas over here I bought for $4. Would somebody please buy it from me for $2? I don't want it anymore. I'm scared of it. And then turning around when the price starts to go back up to $3 and $3.50, they're saying, oh man, look, the market's coming back. I'm going to buy it again at $3.50. Doesn't make any sense, does it? Yet that's exactly what we do when it comes to the stock market. We behave irrationally. What rebalancing does is it takes that out of our hands. All we're saying is that if for some reason my bonds and my cash grew by 20%, what we're going to suggest that we do is let's sell off that 20%, capitalize on it while it's at a high point, sell it at a gain, and turn around and let's buy that 20% back over here while the stock price is down. Maybe it's here. We're going to buy it while it's on sale. right? Or excuse me, the other sale. There's a book out called Warren Buffett Invest Like a Girl. If you know who Warren Buffett is, he's one of the most successful investors of our country. He's very wealthy. And I think the reason they titled that was because what Warren Buffett does is that he goes and buys things on sale, which we all know if we're married, our wives come home and they tell us, you know what, honey, I saved you money today because I bought this on sale. Warren Buffett, I guarantee when the market drops, he's standing there with a big bunch of cash just saying to anybody that wants to sell, I'll buy, because he knows it's going to come back. So we're just talking about rebalancing back to the 70-30 if we know your risk, your time, and your objective, and those things have not changed, then we're going to rebalance back to the original portfolio. Principle number 5, I've named tax allocation. I don't know if there's actually a phrase that somebody's done, but that's what I've decided to name this. And I'm focusing upon how your money will be taxed upon distribution. One of my favorite questions to ask people over the years has been this: do you think that when you get to retirement, whether that's 10 years or 40 years from now, do you think that taxes will be lower than they are today in general? My answer that I've received now for over 19 years is an absolute and emphatic no. They think that taxes will be higher when they get there, not lower. So if that's the case, then my follow-up question is this: does it really make sense then for us to continue to overfund locations that are going to be fully taxable? Now, the logical answer is, when you think about it in those terms, is, well, no, that doesn't make any sense at all. Yet we do it every day, and here's how we do it. We have a 401k, so we're talking about this money fully taxable. We have a 401k at work. The company's going to match, say, dollar for dollar on my first 3% of my contribution. So I always encourage people, let's take advantage of the full match. But it's not uncommon for me to find people, particularly those that are in their later 40s, 50s, and 60s, that they're saying, oh my gosh, I'm getting closer to retirement. I got to save more money. And the one place they know they can save money that in their minds is retirement money is their 401k. So instead of just contributing that 3%, they start contributing 4 and 5 and 10. And I've even seen 20% of their income going in to that 401k. They're only getting matched on 3, so they're putting in 7% more than they need to, or 17% more than they need to. And all they're doing is kicking that tax can down the road, and they're saying, you know what, I'll deal with it when I get there. Well, we just agreed that taxes are not going to be lower, so why do we do that? I think we do it from a lack of education or a lack of understanding of how these things are going to be taxed when we get there. By the way, the things that fit here are going to be your pension, your 401k, a traditional IRA, and things like a 403b or a 457 or a tax sheltered annuity. All of those types of things are going to fit in the fully taxable area. So we just want to understand and help people understand we're okay with developing a bag of money here. In fact, I'm really emphatic. Go get the match. You know, it's free money. Let's go get it. Let's just not put more in there than is necessary to get the match, because it's just going to be taxed at a higher rate at some future point. The second way that your money can be taxed is that it can be partially taxed. So partially taxed money is, let's say that you decided that one day you were going to open up an E-Trade account. And inside of that E-Trade account, you were just going to buy with money that you had saved up already a mutual fund, and you invested in XYZ mutual fund. And you put in $10,000. And 5 years later, you sold that $10,000 original investment for $15,000. Well, the $10,000 had already been taxed. You had paid that tax as you earned it. It was sitting in savings. It's already been taxed. The $5,000 that you earned has never been taxed. And so that's now going to be taxed, and it's only going to be on the gain. If you've held it longer than 12 months, then it's going to be what we call a long-term capital gain. That long-term capital gain is the portion that we're talking about being partially taxed. So things that fit in here would be mutual funds. It could be investment real estate, Let's say that you bought some real estate and you decided to hold it, and then at some future point you were able to sell it and make a gain, and it was not your first primary or secondary home. It was just some investment real estate. Once again, partially taxed. The third category is going to be tax-favored money or tax-free. Now, once again, we're talking upon distribution, just to be clear, so nobody forgets. When we go to use the money, how's it going to be taxed? That's what we want to understand. Tax-favored is a Roth IRA. Now, about 50% of the public understands what a Roth IRA is. Some people have never heard of it. There's even versions of a 401k that is a Roth 401k that some companies have made available. What you'll find is that with a Roth IRA, the money that you put in is after-tax money, just like we did here in the partially taxed, going into a mutual fund or whatnot. But now, what you have the advantage of is anything that grows to is going to be tax-free. So in this example, we put in $10,000 and we sold it for $15,000. That $5,000 was going to be taxed. In this category, we put in $10,000 and it's worth $15,000. Now we're going to get out that extra $5,000 tax-free as long as we've held it for at least 5 years and we're over 59.5. If we do those two things, then we're in a great shape to be able to pull that out. Another location that we see is Muni Bonds. I used to hear a lot about Muni Bonds in the late 90s. Hardly hear them mentioned. In fact, I never hear them mentioned and haven't for the last 10 years plus unless I bring it up with a client. Municipal bonds are not taxed at a federal level. They can be at a state level, but they're not at a federal level. And then we have the cash values of a permanent life insurance policy. Many of us have heard of whole life. Some have heard of universal life insurance. Those are both types of permanent life insurance. The cash values that accumulate within them are going to be tax-free.